Hello and welcome to today's webinar on pension death benefits. My name is Lisa Webster and I'm one of the senior technical consultants here at AJ Bell. So what we're going to look at today then, start off with the basics about pension death benefits, so covering what can be paid and how is it taxed. I'm then going to have a look at beneficiaries, what actually a beneficiary is, who can be a beneficiary and why a beneficiary isn't just anybody, and what that actually means in practice. I'll then turn to inheritance tax and pensions, look at some of the rules and pitfalls and things to be careful of around that. Moving on to bypass trusts and when they could still be appropriate for death benefits, and then finally I'll finish off with looking at the statutory permissive override, which is in place, which can be useful in certain circumstances to be able to give a bit more flexibility in how death benefits can be paid from certain schemes. So starting off then, just to cover off the basics, I'm sure it'll just be a bit of a recap for a lot of you. What can be paid when somebody dies, a pension member dies, and how are their benefits taxed? So two options when it comes to paying out death benefits from a pension scheme, a lump sum or a pension. So lump sums can be paid to individuals, trusts. We can have charity lump sums, which may or may not be a trust, a type of trust, but pretty much anybody can receive a lump sum, and any sort of different kinds of entities, not just an individual person. So it's very flexible in terms of who can be the recipient of a lump sum. When it comes to pension, then it is slightly different because it is only a beneficiary, which I'll look at in a bit more detail, that can receive an income from a pension scheme. So obviously under a DB scheme, that might be it would be a scheme pension. Also looking at annuities, beneficiaries annuities. And obviously in our world, in SIP world, then you're looking at flexi access drawdown, which would only be paid to a beneficiary, which isn't just absolutely anybody. In terms of how those payments are taxed then, I mean, the rules on tax treatment of death benefits are very generous now. I think when pension freedoms came along, back in 2015, everyone was quite sort of surprised by the generosity, really, of it. So if the pension scheme member dies before their 75th birthday, in most circumstances, then all of their funds can be paid out free of income tax to their beneficiaries, to individuals who's being paid as a lump sum. The lifetime allowance test applies to uncrystallised funds only. So if somebody has already started taking their benefits, all the funds are crystallised, you don't get a second test on death. It's not like if you're in drawdown and then you hit your 75th birthday, you get a second test. There's no second test on death for crystallised funds. It's just the uncrystallised funds, so funds that have never been accessed, that have never been tested against the lifetime allowance, basically. Then on death, they would be tested. But that aside, for the lifetime allowance test aside, it's normally paid free of income tax. The caveat on that is that it does have to be designated or paid out within 2 years. So if it's a lump sum payment, then it has to be paid out within the 2-year period. But if it's going towards a pension, so in our world, flexi access drawdown for the beneficiary, it only has to be designated within 2 years, which means put into an account, into an arrangement in the beneficiary's name. It doesn't mean they have to take any income. There's no time limit whatsoever on them taking the income, as long as it's put into an arrangement in their name within the 2-year period. They could not touch it for 5 years, 10 years, however long. And when they do come to take an income from it, it would still be free of income tax at that point in time. The 2-year window, it is actually 2 years from the date the scheme administrator was notified of the death, rather than the date of death itself, or 2 years of when the scheme administrator could reasonably be expected to have known of the death. So that's before 75. If the member lives till past 75, obviously as you hope that's going to be the case with the majority of your clients, then the beneficiaries, when they come to take the income, it is taxed at the marginal rate of tax if paid to an individual. So if it's a lump sum, it will be subject to income tax in that year, and if it's put into drawdown, then to beneficiaries drawdown, when they choose to take an income from it, it will just be taxed as income for them when they take it. If it is paid as a lump sum to a trust, then we have this special lump sum death benefit charge of 45%, which I will look at a little bit more about that if you're paying it to trust when I talk about bypass trust later. But yeah, there is this 45% charge. But on death post 75, there is no lifetime allowance test, because all the funds will have always been tested already. So even if they weren't crystallised, they would have been tested at age 75. So there's no further test for members that die past their 75th birthday. And the same tax rules apply if you have a member that dies before 75 but they miss the 2-year window. So it means that it does get subject to income tax, but no lifetime allowance test. Touched briefly on charity lump sum death benefits. So there are special rules for this. There's only certain circumstances when lump sum payments will qualify as a charity lump sum. And the main criteria really is that they can only be paid if there's no dependents of the member. So it doesn't matter if you've got a very wealthy couple and one of them dies, and if they want to leave their pension to charity because their spouse has their own independent needs, no need for the money, you can't actually do that. Obviously they can still choose to pay it to a charity, but it wouldn't class as a charity lump sum death benefit whilst their spouse is still alive, whilst they still have a dependent. It would only be when there's no dependents left that this is an option. It can only be paid to a charity nominated by the member. So even if you have circumstances where the member doesn't have any dependents, if they haven't nominated the charity themselves, their family members can't nominate one for them, or the scheme administrator. That doesn't work either. It has to be the member's choice of the charity that they nominate, obviously in their lifetime, for where they want the funds to go on their death. It can't be done afterwards. If it qualifies, if it meets those criteria, then there's no lifetime allowance test for a charity lump sum death benefit. So obviously that's only going to be relevant if the member dies before the age of 75, because if you die post 75, there's no lifetime allowance test anyway. So so it may be that you want to consider a charity lump sum death benefit if you have got somebody that's got lifetime allowance issues, so they're going to be over the lifetime allowance, and they don't have any dependents, then they might want to use the charity lump sum death benefit. And then the last point is that it's paid tax-free, which again, so for members that die under 75, it's normally paid tax-free anyway, apart from the lifetime allowance test. But obviously that makes a difference if you've got clients that die over the age of 75, where it would normally be subject to income tax. If it qualifies as a charity lump sum death benefit, then it can be paid to the charity tax-free. Just looking at the lifetime allowance test itself on death then. So there's 3 potential tests that you can have on death. I say all apply to uncrystallised funds only on death before 75. So we have this BCE 7, 5C and 5D. BCE 7 is when you use those funds to make a lump sum payment. In practice, I can't think of any reason why you would ever want to use that option unless you can't avoid it, because if you have the choice of having it as drawdown, then obviously the tax charge is going to be lower. So if you have if you do use BCE 7 and you use those uncrystal funds to make a lump sum payment, then the LTA charge is 55%. If instead you put those funds into flexi access drawdown for a dependent or a nominee, then the LTA charge is only 25%. And of course, under flexi access drawdown, you can take the whole fund out as a lump sum if you want anyway. And obviously it's going to be on death before 75, so that will come out tax-free. So you're much better off putting it to flexi access drawdown, even if you want to take it all out on that one. Once funds have been designated to the beneficiary, then there's no further BCE when they come to take benefits themselves, because it's a beneficiary's arrangement. There's no further BCE, no further test for them. So it's never tested against the beneficiary's lifetime allowance. The only test is always against the deceased member's lifetime allowance, including obviously being able to use any lifetime allowance protection that the deceased member may have held as well. It is the personal representatives that are responsible for carrying out that test, not the scheme administrator. So it is different than how lifetime allowance test works in the member's lifetime. So when the member dies and we do the distribution of death benefits, we as scheme administrator would send the information to the personal representatives of how much the lifetime allowance has been used by that distribution, whether it's a lump sum payment or whether it's a designation into flexi access drawdown. We will tell the personal representatives, we'll give them that information. They will collect that from, if the deceased had maybe had more than one pension, they would get that information. They give that information to HMRC. If there is any lifetime allowance charge, it is then chargeable on the recipient of the benefits. Obviously, any beneficiary that had a lifetime allowance charge to pay, they would be able to access the funds in order to be able to pay that. The final point there, I think I've already covered that, doesn't apply if the funds are distributed after the 2 years, you get income tax instead. So let's have a little bit more of a look at beneficiaries. I've sort of mentioned it a few times. What is the actual sort of technical definition? What do we mean by a beneficiary? So there's 3 different classes of beneficiary. The first one is a dependent, and the definition of a dependent hasn't changed for a long time. This is the same definition that was around pre-pension freedoms. So a dependent is a spouse or civil partner, will automatically be a dependent of the member. We also have a child who is under 23, or it could be an older child who is dependent due to mental or physical impairment. And then we also have somebody that could be financially dependent or mutually dependent. We talk about people being mutually interdependent, which is often the case with sort of cohabiting couples. They may be meet the criteria of dependent depending on the circumstances for that. So we have a dependent, which we're probably reasonably familiar with that definition. And then we have a nominee as well. So a nominee is basically anybody that is nominated by the member who isn't a dependent. So a dependent is a matter of fact, whether they meet these criteria or not. Anybody else that the member chooses to nominate will be a nominee. And it doesn't matter what class they're in. So, for example, if you fill in an expression of wish nomination form and you might put a child on there who at the time of completing it is 20, and if they're 20 years old, they're going to be classed as a dependent because of a child under 23. But by the time that the member dies, that child's now 25, they'll no longer be classed as a dependent, but because their name's on the form, they would still be a nominee and they could still be a potential beneficiary. It doesn't matter that the class has changed. It's maybe slightly different in terms of how the scheme administrator considers them when they come to exercising their discretion, which I'll talk about a little bit later. But they'll still be a potential beneficiary, whether they're a dependent or a nominee, if they've been named on the expression of wish or on the nomination. There are certain circumstances where a scheme administrator can make a nomination, but it is limited to when there's no dependents of the deceased member and they haven't made any nominations. So it's really when there's nobody else that's been named, so there's actually no dependents there. So if somebody's not completed an expression of wish or left any instructions at all, if they had a dependent, then that would be the only potential beneficiary. if there is no dependents and no nomination, or if they've made some nominations but those people have predeceased them, those circumstances as well. If it's absolutely nothing or nobody that's a beneficiary, then in those circumstances the scheme administrator can make a nomination. And then the third class of beneficiary we have is a successor. So a successor is always on second or subsequent death. So you never have directly have a successor of the member. You have the member will always go, their benefits will either go to a dependent or a nominee. And then if the dependent or nominee keeps those funds within a pension in terms of flexi access drawdown, and then on their death they get passed on again, then you would have a successor, and you could have successors flexi access drawdown. So a successor can be nominated by a dependent, a nominee, or another successor, because you can have successors of successors of successors. So you can, in theory, go on for years and generations. Obviously, we're not quite at that stage yet because we've only had these rules for 6 years. But theoretically, yes, you can have successors and successors that carry on. There is no concept of a dependent of a nominee, or a dependent of a successor, or a dependent of a dependent. So the fact of whether somebody meets the criteria of being a dependent, those, spouse, civil partner, child under 23, etc., that's only relevant on the first death, so when the member dies. But on the second death, so it's already a beneficiaries drawdown plan, then it's just everybody's a successor, whether they are dependent on that beneficiary or not. And similar to with the nominees, really, that a successor can only not be nominated by the scheme administrator where the deceased beneficiary hasn't made any nomination themselves. Hopefully that makes sense. Another way of looking at it, if you prefer it in a picture form, is if we have a member here, we have the original pension scheme member. He has a dependent. In this circumstances, that's his wife. Dependent, to say, is a matter of fact. You don't have to write on a form or anything to define whether they're a dependent or not. So because it's a spouse, they would automatically be a dependent. His potential beneficiaries, he might make some nominations as well. So he's got children there that are adult children over the age of 23, so they're not going to be dependent on him, but he might still nominate them. They would be nominees. Nominees doesn't have to be family, it can be absolutely anybody. So if he wants to leave some money from his pension to his best mate who he goes down the pub with every week, in the days when pubs are open, hopefully we're getting there now, then that, that would count as a nominee as well, and the scheme administrator would consider that if that was written on his nomination form, that he wanted us to consider them when distributing death benefits. And then on subsequent death, we have successors. So if the member died, left some money to his daughter as his nominee, then on her death, if there were funds still in the pension, she may choose to pass those on to her child, who would be then classed as successor, because it's, it's the second generation down, if you like. But of course, the member also has the option of leaving funds, making a nomination directly to his grandchild if he wanted to, and that would be a nominee. So even though that child is under the age of 23, they wouldn't be a dependent because it's not his child, it's a grandchild, not a child. So it has to be a child of the member that's under 23 to be classed as a dependent, not just any child under the age of 23. So why does all this matter about, being a beneficiary or not being a beneficiary, being nominated or not? And so it all comes down to, really, it's a matter of how you can take your benefits. It gives you the option of having, in our world, in SIP world, flexi access drawdown. It may be, or they could purchase an annuity. Whereas if you're not nominated, then you only have the lump sum option. So a little example of, say, consequences of getting it wrong sounds a little bit dramatic. There's sort of tax implications. There may be better ways of doing things. So this example here is, we have Tony, who's 85 years old at the time of his death. Tony's wife has predeceased him. He has one child, who is John, who's 55 and is a high rate taxpayer. as his only child, it probably seems quite an obvious thing to do for Tony to say, right, I don't have any dependents, you're my only child, I'm going to make a nomination so that John gets everything of his pension on Tony's death. And that's fine. And obviously John would then have the option, as he's been nominated, to either receive that as a lump sum or to have that in flexi access drawdown and to take income as and when he wants. But obviously he's already a high rate taxpayer, so any income that he takes, he's going to be paying at least 40% tax on, because his dad has died over the age of 75. But John also has some children of his own. So he's got Martin and Kirsty, who are both students, who are both at university, and frankly costing John an arm and a leg at the moment. You know, he's paying university fees for them. He's probably paying for their living costs as well. Now, so if the money goes from Tony to John, he can use some of that money towards his costs of paying those fees, paying for his children. But say he's going to be paying 40% tax to get it out. What would have been more efficient, obviously, is if some of the death benefits from Tony went directly to Martin and Kirsty, because they're not working, they don't have any other income, they do have a personal allowance, and obviously then at a basic rate band above that, which would still be less tax to be paid, so be more tax efficient than if John has the money. Now, if they've not been nominated, John might say to the scheme administrator, actually, I don't need to have the whole fund. Could you pay some of it directly to Martin and Kirsty? And the scheme administrator might agree to that. I think that sounds reasonable. But if they've not been nominated, they can only pay them as a lump sum, which means, yes, when the year they get that payment, they can use their personal allowance, they might pay basic rate tax on it. But, you know, you could only do that once. And obviously, depending on the size of the sum they want to go to them, you know, some of it they might get into higher rate tax band as well, you know, depending on the numbers involved. And of course, what we're getting to is that it would be much more efficient if Tony had also nominated Martin and Kirsty to receive some of the funds, because if they did receive some of the funds, then they could also have nominees flexi access drawdown. So they could take out income every year. So they could take out up to their personal allowance, which should, you know, cover their university fees and a little bit more towards living costs. If they did want to take out more than the personal allowance, then they'll be able to paying basic rate tax on it. And obviously they can do that, you know, every year they get those allowances. So it just means it's much more tax efficient in certain circumstances to have nominations not just going necessarily to the next generation who might be a high rate taxpayer, to sort of put it a little bit further down the line, which, you know, in these circumstances, it doesn't seem unreasonable that the grandfather might want to help pay for the education of his grandchildren. So just want to bear in mind, really. Last slide I've got on the beneficiaries drawdown then, a couple of things to remember. Funds are always kept separate, so if the individual has their pension in their own right, so if somebody had a SIP with us in their own name, they could then have beneficiaries drawdown paid into their own SIP. It would just be kept in a separate arrangement, but it can all be within the same SIP, but just funds are kept separated. When you take any income from beneficiaries funds, so from beneficiaries flexi access drawdown, it doesn't trigger the money purchase annual allowance, so it doesn't restrict the ability for that individual to make contributions into their own pension arrangement. That's absolutely fine. So obviously, if people do need income and they have got beneficiaries drawdown as well, it's, you know, it's best, can be best to take that first before they start accessing their own pension. As I've touched on already, I think no impact on their LTA. So it doesn't matter if your beneficiary has lifetime allowance issues, because it's never going to be tested against their lifetime allowance. It doesn't have any impact on that. We do have junior SIPs, so you can have beneficiaries that are under the age of 18 and have a SIP set up for them to have beneficiaries flexi access drawdown. If they're under 18, it would be set up by the parent or legal guardian who would have control of it until they reached 18. They can make withdrawals as long as it's for the benefit of the child. So the most obvious example on that would be to pay school fees. Obviously, it can be a very tax efficient way of doing it, obviously using the child's allowances and doing it that way. If you do have SAS clients, and again, you can have a SAS beneficiary who isn't actually like a full member of the SAS. And again, that can be especially useful if you have children who and you have a family SAS. You probably don't want to do it if you've got other parties involved. But if you had a family SAS and the parents died or grandparents and they wanted to leave some benefits to a child who's under 18, obviously they can't become a full member of a SAS, so they can't become a trustee if they're under 18, but they can be a beneficiary and still have income paid out from that as a beneficiary of that scheme. So the other trustees will be making all the investment decisions on them, which is in that scheme, which is why probably only really works if it's sort of a family arrangement, so they have family members who obviously will still look after the beneficiary's interest and consider that as well when they're making those kind of decisions. Okay, moving on now to look at the position on inheritance tax and pensions. So generally speaking, pensions are paid out free of IHT, and they're kept outside the estate. Not always true 100% of the time, but the majority of the time it certainly is. And the reason for that, part of the reason that why pensions can be paid out free of inheritance tax, is because there's not an absolute right to the pension, that it is a discretionary trust, and that the scheme administrator exercises their discretion in terms of how death benefits are paid out. So that means the member doesn't usually make a binding nomination. Now, there are certain schemes where binding nominations can take place. Other providers, there's a handful out there that do that, and it may be appropriate if it's going to the spouse or somebody doesn't have inheritance tax considerations, not like to have an inheritance tax issue. But the majority, like our schemes, it is the scheme administrator's discretion as to how benefits are paid out, and the reason we do that is so there's no inheritance tax, so it's not going to fall within the estate. I often think it'd be a lot easier if we could have binding nominations and we didn't have to exercise our discretion. It would make things a lot more straightforward. It'd be nice if there was sort of just a general exemption for pensions, but that's not where we are at the moment. So we do have to use discretion in order to ensure that the sort of pensions are kept in most of the time out of inheritance tax, kept out of the estate. There are still certain circumstances where inheritance tax still may apply. One is serious ill health transfers, which I'll look at in a bit more detail. The other one is contributions in ill health. If somebody is in ill health and they suddenly start putting in more into their pension scheme in the 2 years before they die, then that can be caught as well. So in terms of our nomination form and sort of how we've set things up in terms of to give us the maximum flexibility for members to help us when we're exercising our discretion. This form I'm sure will be familiar to a lot of you, but we do it slightly different than some other providers. So what we have here, this top bit here, is we have the nomination. So the nomination here, which says, in the event of my death, I nominate all individuals who are eligible benefits recipients as defined in the scheme trust deed and rules as the persons to whom you should consider allocating any death benefits from my SIP. Okay, so that is the nomination part. And then underneath we have the expression of wishes. So that nomination there refers to our scheme rules, which the relevant bit is here. So what we are saying in our scheme rules is that any eligible benefit recipients are, in relation to the person, spouse, grandparents, descendants, their descendants, spouses, successors, persons interested in their estate, etc., etc. It's a really wide-ranging definition. So what this means is if you fill in, if your client fills in our nomination form, regardless of what they write down here in the expression of wish part, they have nominated all their family members, pretty much. So it's their it's grandparents, descendants, spouses, adopted, etc. So it's the wide family have all been nominated. What that means is that when we exercise our discretion, if we think it's appropriate to pay it to, you know, somebody's niece, nephew, grandchild, whatever it is, who isn't a dependent, then they could still receive, because this nomination nominees flexi access drawdown, they wouldn't be restricted to the lump sum. So going back to my example where I had Tony, who died at 85 and just left all his money to nomination to John, who was a high rate taxpayer, but then he's got his grandchildren. Actually, if they filled in our form in those circumstances, we could have paid nominees flexi access drawdown to the grandchildren. We could have designated funds into an arrangement in their name, but not all scheme administrators do it like that. So it is sort of relatively unusual how we do it. So for a lot of schemes, that won't be the case. You would actually have to put their name on the form. And I know a lot of the time, you know, people will write sort of 98% spouse and then 1% to each child or whatever it is, just so you get their names in there, which is fine. That works as well, as long as their names are on there. Then the percentage can be varied at the discretion of the scheme administrator. The point is the nomination is on there, but with our form you don't actually have to do that, because this nomination section here on the form sort of covers that for you. And then underneath it we have the expression of wishes section, which is where, you know, the member tells us who they really want it to go to and gives us the direction. There is actually, you see the form itself, I can get it all on the screen, there's a note section below it where you can free write any instructions as well, any considerations that you want to put. So we do sometimes get asked if we can accept just a letter of wishes, as in just a handwritten or, you know, a free written letter of instructions, letter of wishes, which of course we can. And I know some advisor firms might have their own template that they use with their clients, which we can accept other forms. That's not a problem for us to do so, but I would also encourage everybody to use our form, because, you know, it's been designed to give the maximum flexibility, so that, you know, if it is appropriate to pay to somebody that's not named on there for whatever reason at the time, if it's not been updated, or, you know, the person who has been nominated doesn't want to have it, or they want some of it to go to somebody else, it just gives you that flexibility. So I would encourage people to, you know, to use our forms where possible, but say it's not an absolute, you have to, you can't accept anything else. So in terms of what happens when somebody dies, and the role of the scheme administrator, what we actually do, how we pay out death benefits. So we have the discretion as to whom the death benefits are paid out and how it's split between the potential beneficiaries. We will be obviously guided by the member's nomination, what they've written on the expression of wish form or any letters of wishes, but we're not bound by it, because we can't be bound by it, because if we were, then it would fall into the estate automatically and you'd have identity issues. And as I've mentioned, if there's absolutely no nomination, or whoever's been nominated is predeceased the member, no dependents, then only then can we nominate somebody to be a nominee to receive a pension, opposed to just a lump sum. When it comes to exercising our discretion, we will look at, obviously, the expression of wishes. We will also look at the will. Now, it doesn't mean that it has to match up. You know, the will doesn't have to say what's happening to the pension, or, you know, be split in exactly the same way or anything like that. But it helps with things like if the, for example, the pension nomination isn't going entirely to the dependent, and there is a dependent, and they want money to go elsewhere, we always have to consider the dependent and make sure that anybody who's a dependent is catered for. And it might be that actually they've left everything in their will to their spouse, their dependent, they've provided for them there. So actually they don't need to have the pension, because, you know, they've got enough elsewhere. So things like that can help, it can be relevant. Marital status is obviously important, particularly if it's changed since the last expression of wish. You know, has the member got married or divorced, separated, what's happened? You know, other relevant information, you know, have they had some more children? since we, which aren't included, on the expression of wish, people that are on there passed away, things like that. We have to consider all the relevant information, and also we have to disregard any irrelevant information. There's been quite a notable increase in cases going to the Ombudsman regarding scheme administrators' discretion when distributing death benefits, not surprisingly really, since the rules changed in 2015, because the rules are more generous, more people can be beneficiaries, so it does open it up to some more disputes. So the Ombudsman has looked at quite a few of these cases, and this is just sort of some of the things that have come back for the Ombudsman. So what they've said here as an example is, say you have an expression of wish form stating, I want to leave all this to my dear wife, that was signed in 1995. You need to make sure they're still living together. You need to ask a few questions. Quite often somebody's written that expression of wish, might have forgotten about it, got divorced, moved in with someone else, had some children. It can be very complicated. So the key bit here is this last line, really, I think, is that we have to make sure the decision isn't so out of kilter that no other reasonable body of trustees would have made it. So the Ombudsman in these cases that, so there have been quite a number of cases that come to the Ombudsman will never make a ruling and tell the scheme administrator how to distribute death benefits, because there is no right or wrong answer. They just have to make a decision, I say, that's reasonable, and you have to have considered all the relevant information, I say, and disregarded anything that's irrelevant. So there are cases where the Ombudsman has looked at it and they've said, no, scheme administrator, you haven't considered this, that you should have done, or you've based your decision on this, which actually isn't relevant. You need to go back and make your decision again. And yeah, so they may throw things back to the scheme administrator to remake their decision, but they don't actually ever tell the scheme administrator what to do. So obviously from our point of view, it's helpful to have up-to-date information. We're just saying about forms being signed in 1995. Yeah, it's good to make sure that these things are kept up to date, which will make things a lot easier for us as scheme administrator to exercise our discretion when the time comes. And obviously, if we're not having to go back and get more information because circumstances have changed, go back and forth with the family, it's obviously what is a distressing time. It makes things a lot easier for everybody. Okay, moving on to serious ill health transfers. I'm sure most people will be aware of the issue and the infamous Staveley case, where Mrs. Staveley transferred an ill health, and the ongoing for many, many years dispute with HMRC as to whether inheritance tax was liable or was payable or not. So where we're up to now is that if a transfer is made in the 2 years before death and the member was in ill health at the time of the transfer, funds could potentially be liable to inheritance tax. There is no spousal exemption as well on this one, so don't think just because they're leaving the benefits to the spouse that it's not an issue, because it can be still. The reason there's no spousal exemption on this is because it's a chargeable lifetime transfer, not a pet, so it can still apply. There are certain circumstances where you can transfer an ill health, and even if the member dies within 2 years, it won't be liable to inheritance tax. There is this Section 10 exemption under Inheritance Tax 84, which is dispositions not intended to confer a gratuitous benefit. Basically, what that means is if you can demonstrate that the reason for the transfer is to benefit the member in their lifetime and not for the beneficiaries and not for the death benefits. So, for example, if you're transferring because the member wants to access benefits, which in a way they can't do under their current scheme, and as soon as the transfer goes ahead, they start accessing those benefits or take an increased level of benefits or whatever it is, or if it's for, service level investments, costs, usual reasons you might transfer, and you obviously document that very well, and keep your records then, and you can clearly demonstrate that that was the reason for the transfer, not to improve the death benefits. Also, the fact that you have the same beneficiary before the transfer and after the transfer doesn't mean that inheritance tax won't apply. The way HMRC look at this, whether you agree with this or not, it's a different matter, but the way they look at it is at the point of transfer, the death benefits could have been pointed to the estate, so that when you've transferred it, because you're not paying it to the estate, when it's in the new scheme, that is still, but you could have done, then there is still the potential loss to the estate, to say, even if it's the same beneficiary before and after. Now, obviously, there will be cases where you want to do a transfer in ill health, and the reason will be because of the death benefits. Obviously, example would be somebody who's in a DB scheme, particularly if they do not have any dependents, and basically on their death, then the pension dies with them. Now, if you transfer it, obviously death benefits will be paid out. Even if they're subject to IHT, it's still be better to get something rather than nothing. So it could be, still a good reason to transfer, but you obviously need to be aware that inheritance tax might apply to that, obviously, when you're giving the advice on that. So what is the potential loss in those circumstances if inheritance tax did apply? How do they work it out? First thing to bear in mind, it is not the whole transfer value. That's good news. The loss to the estate, how HMRC look at it, is the open market value of the death benefits, which could have been directed to the estate at the point of transfer, less the open market value of the lifetime rights comprised in the receiving scheme. So we've got a case study to look at that. So we've got John's terminally ill, he's got less than a year to live. He transfers £500,000 from his retirement annuity contract to his SIPP, and he dies within 12 months. So his executors then have to report that transfer on the IHT 409 form, but what might the liability be? So at the top then, we've got sort of the calculation, how they work it out. So loss to the estate, open market death benefits. So the value for that is going to be close to the transfer value. But if we make an assumption of, say, 3.5% growth between the transfer value and date of death, and then apply a discount rate of 7.5%, which is one that we've seen HMRC use in their calculations, that would leave you with an opening value there of £480,000. And then you deduct from that the open market value of the lifetime rights, which in the receiving scheme, the maximum you could take out, if you did that on the day you got the transfer in, you immediately took a UFPLS, uncrystallised funds pension lump sum, of the whole amount, took everything out, you would get a quarter of that tax-free, £125,000, and then the rest of it will be subject to income tax. It works out around £220,000 after tax. You would get as the post-tax amount, and then if you add those together, so your total lump sum that you would have would be £345,000. So the loss to the estate is the difference between those two. So you're looking at £135,000 would be the potential loss to the estate, and that's the figure that HMRC would then apply inheritance tax at as a rate of 40%. So it's just over 50,000. So yes, there would be an inheritance tax on it, but it's not 40% of the full value. It's not as bad as that. It's whatever that works out to be, 11–12%, something like that, of the value. So obviously will vary depending on how long you live past the date of transfer will be a relevant factor as well. So you need to be aware that inheritance tax can apply in these circumstances, but it's not necessarily a reason that you wouldn't still want to go ahead and do it. The other thing that we have is that anecdotally we've heard from quite a number of advisors that even when this has all been reported on the IHT forms, the estate has been settled and HMRC have never come after it for it. Obviously you can't advise on that basis, it's not guaranteed, but we have seen cases where they haven't come for it. So yeah, it's a bit of an interesting one. Okay, moving on now, last couple of things. Bypass trusts, let's have a quick look at this. So obviously we have pension freedoms now, and we have freedom, a lot more freedom on how and whom we can leave pension benefits to. Before pension freedoms came along, it used to be only a dependent that could get a pension, and now it is anybody, as long as they're nominated. When you inherit a pension, though, it becomes the beneficiary's property, so they can do what they like with it, which can potentially cause issues. There's obviously issues, potential issues, where you have young members. You'd like to leave some benefits to somebody, but maybe even if they're not minors, they might be like late teenagers, early 20s. If it's a large sum of money, do you want them to have free access to do whatever they want with it? You may want to leave funds to family members that they want to provide for, but they may have concerns. They might have addictions or something, with gambling, drinking, whatever. There's all kinds of issues where people maybe they want to provide and look after people and leave things for them, but actually they don't want them just to have the complete freedom to take out the whole lump sum and blow it and do whatever they want with it. So that's one issue with leaving it for a beneficiary, that they can do what they like with it. Another might be not so much they don't necessarily trust them with the money, as it were, but when the beneficiary has those benefits in their own name, what happens to them after their death? It's up to them. The member has no control what happens on second death. They can leave it to whoever they want. And when passing funds on within a pension, there's nothing you can do about this. If you're keeping it within a pension environment, then once you give it to the beneficiary, it is theirs to do whatever they want with it. This can obviously be an issue. One example is pensions blended families. So here, if you have a couple that are married, have a couple of children, wife dies maybe at a young age, leaves her pension to her husband. He then goes and remarries somebody else after her death. So they have a child together, but then on his death, he might leave it, to support his current wife. And then on her death, she's likely to leave it to her child, and his children from his first marriage get nothing on it. So a bypass trust can still be relevant to sort of deal with these kind of issues. So it's a discretionary trust set up to receive the pension death benefits, and the member appoints the trustees and instructs them how to distribute the funds. So the trustees then do that according to the member's wishes. So yes, you can have a spouse pay an income to the spouse in their lifetime, and thereafter to children from the first marriage. That might work. You can make a loan to the spouse, which could be repaid on death. It could be, for if you are leaving it to people that maybe who aren't very good at looking after money themselves, that you could pay them just a regular income without them having access to the lump sum, all sort of things like that. So it can give a lot more control for the member as to what happens to their money, how it's used after their death. So it does have a lot of advantages in that way, which you just don't have with a pension at all. But of course, the downside of it is it's not as tax efficient as leaving it in the pension. So if the member dies before 75, it's less of an issue, because that just gets paid if it's distributed within the 2 years and within the lifetime allowance. It can be paid tax-free into a bypass trust and then dealt with from there. But if the member's over 75, then you have this 45% tax charge when it goes into the trust. But when that trust later makes distributions, then the beneficiary can claim tax relief for that 45% tax, and they have a tax credit, which I've got an example of in just a moment, how that works. But is a discretionary trust. It may be subject to IHT charges every 10 years, so it depends how long the money's likely to be in the trust, whether that's going to be relevant or not, but also exit charges. But the other point as well is that obviously at the point it goes into the trust, because you have the 45% tax deducted, even though you get a credit back later, obviously there's less money going into the trust to then benefit from investment growth and the effects of compounding, etc. on that. So yeah, there's no doubt it's not as tax efficient as the pension, but how tax efficient or not it is, it will depend on the circumstances a little bit. And is the cost of control, what's more important? Some people will be willing to pay a bit more tax in order to have that control, because that will be important to them. Case study then about how the tax credit works. So we have Mr. Lee here who dies age 76, so that's going to be paid over the age of 75. There will be 45% tax charge will apply. Here's a SIP worth £300,000. Death benefits get paid to a bypass trust. Trustees later make distributions to each of his 2 children of £35,000. So what that looks like is you start off with a SIP 300,000. 45% tax has to be deducted by the scheme administrator, paid to HMRC. They get their £135,000. The bypass trust gets £165,000. Later then, the bypass trust will make the distributions. So if it makes a distribution of £35,000, attached to that distribution will be a tax credit, which works out to be £28,636.36, and the beneficiary is treated as receiving £63,636.36 gross payment, because if you take 45% of 63,636, it works out as the 28,636 and leaves you with a net amount of £35,000. So that tax credit is attached, and there's information requirements written in regulations. So when the trustee of the, or when the scheme administrator makes the distribution from the SIP, they will pass information to the trustees of the bypass trust. When the distribution is made from the bypass trust, the trustees will give that information to the beneficiary about the distribution. They'll pass that on, and so that will allow the beneficiary to get the tax credit against their income tax for the year. So for Ruby, if we look at her, before she had this distribution, her income was £80,000. She then has this distribution, so she's classed as having that just over £63,000. So her income for the year is 143. So you then work out your income tax for the year. So if she doesn't have a personal allowance that level of income, that's all been removed. She then has a basic rate tax band, and she has a higher rate tax band, and her total tax bill for the year is just shy of £50,000. What you would do then is deduct the tax credit she's already received for that distribution, and her total income tax payable for the year. So if she's doing self-assessment at the end of the year, her tax bill for the year is going to be £21,278, because she's treated as already having paid the £28,636. If we look at Harry, Harry's not earning as much, so his income before the distribution was £30,000. So his total income works out for the year now as £93,636. We then again do the same for him, do his income tax calculation. His tax due for the year is just below £25,000, but he's got a tax credit of £28,636. So actually, he's now due a refund of the difference. And in fact, if he's just, working as a normal employee, PAYE, then he's probably paid tax already. So he'll get a refund of the taxes already paid, any taxes already paid, and that amount he will get that at the end of the tax year, and he can claim that either via a self-assessment. But if he doesn't have any income and he's normally just a paid employee, he might not do a self-assessment. The other way you can do it is the R44 as well. So you can get the money back. So it's maybe not as bad as it sounds having that 45% tax deducted. But obviously there's timing issues, etc. Okay, one last thing just to finish off with. I'm just going to quick look at the statutory permissive override. So when pension freedoms came along, this permissive override was put in place to allow all defined contribution pension schemes to be able to offer pension freedoms regardless of what was written in their scheme rules. So the statutory permissive override allows schemes to provide flexi access drawdown and uncrystallised funds pension lump sum payments for members, but it also, in terms of death benefits, it allows any defined contribution pension scheme to offer dependents, nominees and successors flexi access drawdown regardless of what's in their scheme rules. So you will quite often get older schemes. Section 32 is probably the most obvious example. Some old types of schemes, which when it comes to the death benefits, the members died and they will say that the only thing they have available is a lump sum payment or an annuity purchase, because they don't have the facilities to pay dependents flexi access drawdown, nominees flexi access drawdown. Now, if they're a defined contribution scheme, as they will be, then they can do it. So it doesn't matter what's in their scheme rules. They don't actually have to be able to pay any drawdown. They just have to be able to designate it, because, you know, I can understand obviously a lot of them aren't set up for it. They might not have the systems, but if they can designate it to drawdown, then member of the beneficiary, should say, can then apply for a drawdown to drawdown transfer on a like-for-like basis. So they don't physically have to be able to pay it, and it doesn't have to be in their scheme rules. They can still just make the designation, and then you transfer it to somebody that can do it, that can actually physically pay it out. And then I've just got the override there, which is in the Finance Act 2004. Schemes won't necessarily tell you that they can do this. They will just say to you, you've got a lump sum or annuity, that's it. They might not tell you that you can that you have this option. Some schemes, when you ask them can they do it, might still say no. You get a computer say no, our scheme rules don't allow it. It doesn't matter what the scheme rules say. It's becoming less of an issue now. I think more schemes are kind of coming around to realizing that yes, they can do this. All we need as a receiving scheme to receive one of these transfers is the fact that the funds are designated into flexi access drawdown in the beneficiary's name, the date they were designated, the amount of the designation, and it might sound a bit funny, but confirmation of whether the MPAA is triggered. That's just, it's in the rules that we have to have that from them. Obviously, if they don't have the ability to pay it, it will never be triggered. But yeah, it's just worth bearing in mind if you have a client, if you're a beneficiary of one of your clients, and the scheme is telling them they can only have annuity or lump sum, and that's not the best option for them, then actually, you know, do go back and mention this override and say, actually, no, you can designate it to drawdown and we'll transfer it to somebody who can do it. So yeah, just bear that one in mind. Okay, that's about all from me. So I'm just going to sort of finish off with a few key points. First one there is just to keep client nominations, expressions of wishes updated. That really helps when we're exercising our discretion. You know, that point about the ombudsman, when you have one, you know, expression of wish which is signed 20 odd years ago, you know, we have to do a lot more work to establish that that's still, you know, up to date and things haven't changed. You know, if we have one that's dated from, you know, within the last 12 months, you know, we know that's much more up to date and it makes things an awful lot easier. I mean, the good practice, if you know, when you have your annual meetings, you just get confirmation that it's you know, update expressions of wishes, you know, so we always know that it's sort of up to date and relevant. You know, you can consider nominating if you want to think about being tax efficient, non-dependent, maximum flexibility. So that I say if it's with us, as long as you fill in our nomination form, then all family members will be nominated. But that's not the same for all providers. We, as scheme administrator, we always have to consider dependents, whether they're named or not. You may want to consider nominating younger, you know, sort of basic rate non-taxpayers where appropriate. So if you're looking at, you know, sort of keeping things tax efficient, you know, that's sort of the case study I had with Tony and John. You know, it may be worth, you know, and obviously this is going to change all the time. You know, reviewing it, you know, each year as appropriate, whether it might be appropriate to have a small portion, you know, to go towards some of the younger generation, the tax efficiency. Bypass trusts, yes, they can still be appropriate. Obviously, we've seen a massive decline in the use of bypass trusts since pension freedoms came along. You know, they're not as tax efficient as leaving it in the pension, but if you have got control, if control is important to a client, then they may still want to consider them. And finally, just the override facility. You know, if you've got a defined contribution scheme and they're telling you that the beneficiary can only have an annuity or a lump sum, don't accept the final answer if that's not going to be the best thing for your client. You know, look at it. You know, they can do a transfer, a drawdown to drawdown transfer. Okay, now that really is all from me. So thank you very much for listening today. I do hope that's been useful, and goodbye.